We have seen turmoil in the banking sector in the US and in Switzerland. And that really reflects the heightened vulnerabilities that have been building up over years of low interest rates. As interest rates are being raised, vulnerabilities are appearing. We saw that already last October when we met here for the annual meetings, where we saw stress in the non-bank financial sector, in the UK more specifically at that time. And we have seen it in March in the banking sector in the US and Switzerland. There are certainly other vulnerabilities out there, and sharp adjustments in interest rates, sharp adjustments in expectations can trigger further stresses. I think one of the key lessons from both the March episode and the October episode is that while there are vulnerabilities that can be triggered and can test financial stability, there are also policy tools that are available to policymakers in central banks and in deposit insurance agencies, as well as finance ministries. And what we have seen is that these policy tools have been deployed in a very effective manner, so that any threat to financial stability was contained and abated very quickly. So vulnerabilities are there, but there are also many tools to contain risks to financial stability.
So how can policymakers fight both inflation and contain financial stability risks?
Yeah, I think what has happened in the past month is very telling in that respect. Central banks will always try to use tools separately to fight inflation via monetary policy and to ensure financial stability via other tools. Starting with the financial stability angle, for example, in the US case, a systemic risk exemption was being used by the FDIC to make sure that the run of deposits would not spread to other banks. That was very effective, and any turmoil in the banking sector in the US was mitigated by the deployment of that tool. There was also a new lending facility that was deployed by the Federal Reserve in order to allow more effective lending to those banks that were under stress. In the case of Switzerland, the government supported a merger between two banks, which again stabilized the financial stability situation. And finally, in the case of the UK, back in October, the Bank of England deployed targeted and time-limited asset purchases to stabilize the LDIs that were under stress. And so in all of these cases, basically, central banks could continue to tighten monetary policy because they had the tools to contain threats to financial stability. The Federal Reserve increased interest rates after the SVB episode. The Swiss National Bank increased interest rates after the Credit Suisse merger. And of course, since October, the Bank of England has hiked interest rates since the LDI episode. So this is really the playbook, that is ideal, where there are financial stability problems, use targeted tools to address those, and continue to use your monetary policy to fight inflation. Inflation remains high, well above target in many countries. What is priced into markets at the moment is a relatively optimistic view about inflation going forward. Inflation is priced in by markets to come back down to targets fairly quickly. And while we certainly hope that this is going to be the case, there's certainly risk around this outlook on inflation. Inflation could prove to be more persistent, which could lead to a reassessment of the path of policy for monetary policy. And, that could again trigger certain financial sector instabilities. So vulnerabilities are certainly elevated both in the banks and in the non-bank financial sector.